After what we've seen in Intel's analysis last week, the logical step is to analyze Nvidia. And here we are, my dudes. Nvidia has been making waves in the news lately, thanks to its impressive performance in the market. The stock has experienced a phenomenal rise, soaring from its 52-week low of $108.13 to reach all-time highs of $437.21. It more than 4x'd in just 8 months, and that's insane. The big questions now are, why is Nvidia performing so remarkably well? Is this growth justified, or are we witnessing another inflated bubble that is bound to burst? Well, my dudes, you're in luck because the finance dude is here to provide the answers you seek. Stay tuned as we dive deep into Nvidia's performance and assess whether it's a genuine success story or a potential bubble waiting to burst. Hey dudes and duderinas, this is the Finance Dude, and before we dive in Nvidia's analysis, don't forget to smash that like button and subscribe to this channel. Now that we have everything ready, let's start with the analysis. Nvidia is a leading technology company specializing in the design and manufacture of advanced graphics processing units or GPUs and related software. Founded in 1993, Nvidia has played a pivotal role in the development of graphics and visual computing technologies, particularly in the gaming, artificial intelligence, autonomous driving, robotics, natural language processing, data centers, and cryptocurrency mining industries. In this episode, we have two missions. First, assess whether Nvidia is a good business, and second, assess Nvidia's valuation. As always, I start this first approach with the 5 dimensions method. And the first dimension to be analyzed is the growth dimension, where I will start with Nvidia's revenue growth. And it's incredible what we see here, my dudes. Nvidia has experienced an astonishing revenue growth of 526.6% over the past decade, achieving a remarkable 20.1% compound annual growth rate. Now, you might wonder why Nvidia's stock price skyrocketed when their revenues decreased by over 4% in the last 12 months. Well, during their latest earnings call in May, Nvidia blew up all expectations by providing a revenue guidance of $11 billion for the current quarter. This figure is 50% higher than what Wall Street analysts anticipated. The demand for AI chips has been the driving force behind this phenomenal performance. In fact, $11 billion represents over 40% of Nvidia's total revenue in the past 12 months. If we extrapolate this guidance to a full year, Nvidia could potentially achieve a staggering $44 billion in revenue, which is 55% higher than the last 12 months' revenue. Such outstanding performance deserves a rating of 5. Now let's turn our attention to net income growth. Here, we can see an outlier in the fiscal year of 2022, which corresponds to the calendar year of 2021. Yeah, it's confusing, but some companies' fiscal years differ from the calendar year due to reasons such as business cycles, operational convenience, align with peers, etc. For example, Nvidia is already in fiscal year 2024. But I digress. Excluding the significant drop in profits from the outlier of nearly $10 billion to the current value of $4.79 billion, Nvidia has witnessed a mind-boggling increase of almost 1,000% in net income over the past 10 years. This remarkable growth seems to align with the stock performance during the same period. Hence, it deserves a rating of 5. Similar trends can be observed in free cash flow growth. However, the free cash flow generated in the last 12 months falls short of Nvidia's cash flows from the fiscal years 2018 to 2022. This performance is not as impressive as the net income growth. Additionally, the current free cash flow amount stands at $2.23 billion, which is only half of the net income. Ideally, we want to see profits backed by solid cash flows, not just accounting profits. If Nvidia moves on to Analysis 2.0, I will further investigate this disparity. Nevertheless, the overall growth of 377.1% is massive and deserves a rating of 5. Now, let's move on to the second dimension of our analysis, profitability. When it comes to gross margins, there is a substantial decline observed over the past year. After experiencing consistent annual increases, the gross margins dropped from 64.9% in the fiscal year of 2022 to 56.3% over the last 12 months. This decline raises several questions. Did the product mix shift towards lower margin products? Were there pricing reductions? Or did the costs of inputs increase immensely? These intriguing factors require further investigation in Analysis 2.0. Given the magnitude of this decline, rating of 1. The same happened to operating and net income margins, and both deserve a rating of 1. Regarding free cash flow margin, I want to further develop. The crash in free cash flows is far higher than we've seen in the other margins. Free cash flow margin went from an average of around 20% to a current margin of just 8.6%, a concerning drop, and we need to be careful here. Given this, rating of 1. Now let's proceed to the third dimension of the analysis, solvency. Starting with the quick ratio, despite experiencing a drop to the lower end of this 10-year period, the current ratio of 2.84 remains rock solid. Nothing more to see here, rating of 5. Moving on to net debt to EBITDA, we can see that although this rating has been deteriorating, Nvidia still possesses more cash than debt. Again, nothing to worry about. Another rating of 5. However, it's important to note that due to the significant crash in free cash flows, the debt to cash flow ratio has also deteriorated substantially. Typically, I prefer businesses with ratios below 5, indicating that the business can pay off its debt within 5 years using the cash flows generated annually. The current value stands at 5.40, slightly above my desired threshold. As a result, it receives a rating of 2. Now it's time to dig deeper into the key dimension of valuation. Unfortunately, we're off to a rough start. The enterprise value to sales ratio of 42.11x is simply insane. You may argue, but dude, Nvidia's growth is out of this world. And I answer, my dudes, even if we were to extrapolate the guidance of the current quarter to a full year revenue of $44 billion, which is 55% higher than the previous 12 months, the ratio would still be 24.77x. This remains an incredibly high multiple that is completely unjustifiable in the longer term. Usually, we see EV to sales multiples of around 10x for high growth, high margin businesses. Purchasing a stock at a 42.11x EV to sales valuation implies relying on perfect execution without the slightest chance of failure. Putting all together, this multiple deserves a rating of 1. A similar pattern emerges when examining the enterprise value to EBITDA, price to free cash flow, and price to earnings multiples. These multiples are simply insane. We're looking at almost 180x for EV to EBITDA, nearly 500x for price to free cash flow, and almost 230x for price to earnings. These figures are astronomical and deserve a rating of 1. However, we do find a positive sign in the forward price to earnings ratio. Unlike considering the last 12 months' profits, this ratio incorporates projected profits for the current fiscal year. Due to the substantial expected growth in profits, we can observe a decrease in the PE ratio to more reasonable levels. Nevertheless, the current multiple of 54.94x remains high and significantly above the levels observed throughout the analysis period. Taking everything into account, it receives a rating of 3. Lastly, let's delve into the fifth dimension of our analysis, dividends. Nvidia has been paying dividends since 2012, experiencing a nice average yearly growth of 7.2% over the past decade. However, dividend increases were halted in the fiscal year of 2021, which is understandable considering Nvidia's current priorities of reinvesting its cash flows into the business. It appears that this strategic focus is paying off. While receiving quarterly or monthly dividends is nice, witnessing our stock investment soaring is even better. Taking all factors into consideration, it receives a rating of 3. Now, let's discuss the dividend yield. After reasonably yielding 2% and 1.8% in the fiscal years of 2014 and 2015, Nvidia's yield has been plummeting to a current yield of 0.04%, which is the same as saying 0%. Investing $438 in one Nvidia share and receiving a mere 16 cents per year is hardly enticing. Personally, I would prefer Nvidia to save this money and reinvest it into the business or use it for stock repurchases. Since the dividend yield is negligible, it deserves a rating of 1. Moving on to the significant metric of shares outstanding, Nvidia has shown inconsistency regarding its outstanding shares policy. We saw a substantial increase in shares outstanding in the fiscal year of 2017 and other minor increases in the fiscal years of 2021 and 2022. But overall, Nvidia has been engaged in share buybacks throughout this 10-year period. Compared to the beginning of the analysis period, Nvidia now has nearly 5% more outstanding shares. Considering all these factors, rating of 2. Now, it's time for the summary table with every 5D component. After carefully examining each component of the 5 dimensions, we arrive at a good final rating of 2.92. Nvidia scores a perfect rating in the growth dimension, but it significantly lags in the profitability and valuation dimensions, which raises concerns, especially regarding the notable decline in profitability. Regarding valuation, Nvidia appears to be on the expensive side, and that's where we will dig deeper in the next 2 sections. But before we get to the juicy part, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay, dudes, we're ready to rock and roll with this DCF valuation. Upon analyzing the historical averages of our variables, we can uncover the positive historical revenue growth, the insane cash flow growth over the last year, and the yearly share repurchase rate of 0.5%. On the negative side, we have the negative revenue growth over the last 12 months. However, we have already established that Nvidia's growth is expected to explode in the coming years, so there's no need to worry about this one. Additionally, there has been a significant decline in the free cash flow margin, dropping from an average of around 18% to 8.6%, and lastly, the price to free cash flow multiple of 489.09x is utterly unrealistic. But hold on tight, because what analysts are expecting in the next few years is mind-boggling. They project an extraordinary annual revenue growth rate of 36.09%, anticipating revenues to skyrocket from the current $25.87 billion to an astonishing $65.23 billion in just 3 years. Now, brace yourselves for the best part, the projected growth in earnings per share. Analysts foresee EPS to surge from the current 1.92 to a staggering 12.35 in just 3 years, representing a total growth of 543% and an astounding yearly growth rate of 85.98%. It's truly astonishing. However, let's take a moment to run a little exercise. Considering the current EV to sales multiple of 42.11x, if we factor in the expected revenues of $65.23 billion 3 years from now, the multiple would still stand at 16.71x, which is above the acceptable multiple of 10 times. And the same happens with PE ratio. The current ratio sits at 228.07x, but if we consider the projected net income in 3 years, the ratio would be 35.47x. While not as outrageous, it still represents a high value. How many years of insane growth would be required to achieve acceptable multiples? See why I said previously that everyone is expecting Nvidia to execute everything to perfection? But enough talk, my friends. I know you're eager to hear my assumptions and the results. My base case scenario goes in line with Wall Street analysts. I anticipate that Nvidia will maintain its dominance in the GPU market, with the data center segment driving significant growth. Additionally, Nvidia is poised for substantial expansion in the AI and self-driving vehicle segments. And this scenario goes in line with what we see in semiconductor industry. The increasing demand for AI and deep learning applications, including large language models like ChatGPT, has created a need for powerful GPUs. Nvidia's latest H100 data center GPU is significantly faster than its predecessor, and the company is one of the best positioned companies to capitalize on this growing market and secular trend. In this scenario, I project cash flows to grow at an annual rate of 44.6% to reach $89.5 billion in 10 years. Revenues are expected to grow at an annual rate of 27.7% to $298.5 billion, nearly 7 times the forecasted revenues for the current year. However, even under this optimistic scenario, we do not achieve our required rate of return of 12%. Buying the stock at the current price would only yield a yearly rate of 8.7%. In 10 years, the share price is projected to be around $700. Although share price appreciation is anticipated, it is not at the rate that I want. Cash is limited and we must allocate it to the alternatives that offer the best returns, not just to an alternative where we will see some share appreciation. This is key in investing world, my dudes, never forget this. Now, let's shift gears to the bull case scenario. In this scenario, I consider a scenario where Nvidia obliterates the competition in the GPU market and emerges as the market leader in the data center, AI, and self-driving segments. As such, in this scenario, I expect cash flows to grow at an astounding rate of 100% per year in the first 5 years, followed by a more modest rate in the subsequent years. This translates to an annual cash flow growth of almost 50% over the next 10 years, reaching $127 billion, and a yearly revenue growth of 31.4% to nearly $400 billion. Considering the expected annual growth rate of 12.28% for semiconductor industry until 2032, Nvidia must gain market share in the segments it competes, which is in line with this scenario. As such, if we purchase Nvidia stock at the current price, we can expect an annual return of 14.7%, surpassing our expected rate of return. In 10 years, the stock is projected to be priced around $1,187. However, keep in mind that for this price to materialize, all the assumptions for this scenario must align, which we know is unlikely. That's why I have set up multiple scenarios with distinct assumptions, allowing us to have a range of prices where the stock may trade based on the behavior of our assumption variables. Now, let's explore the bear case. In this scenario, I anticipate Nvidia facing significant challenges from competitors such as Intel and AMD. Under this scenario, cash flows only grow to $62 billion in 10 years, while revenues reach $229 billion. To achieve our required rate of return of 12%, we should only pay up to $196.97, and we had that opportunity between June 2022 and January 2023. Did any of you buy the stock back then, my dudes? At what price? Let me know in the comments. Now, let's move on to the extreme cases. In the extreme bull case scenario, I assume that besides the secular trend in the semiconductor business that will enjoy great yearly returns over the next decades, Nvidia becomes the absolute leader in all its segments: gaming, AI, data centers, cryptocurrency mining, self-driving vehicles, and robotics. Moreover, Nvidia's dominance in these markets will result in higher margins. In this scenario, cash flows are projected to grow at a rate of 54.8% annually, with revenues growing at a rate of 35%, and the company's market cap would reach almost $4 trillion in 10 years. Investors purchasing the stock at the current price would enjoy an annual return of 20.5% over the next 10 years, with shares being priced at nearly $2,000 10 years from now. This is truly an extraordinary scenario that will need every stars to align in perfection. Lastly, we have the extreme bear case. In this scenario, I consider that all expectations surrounding Nvidia would be shattered. Nvidia's cash flows would only reach $10.6 billion in 10 years, with revenues totaling $53 billion. Due to this poor growth, Nvidia's market cap would decline from $1 trillion to $133 billion, and the stock price would plummet to $53. Admittedly, under current circumstances, this scenario appears highly improbable, which is why I attribute only a 0.5% chance of it occurring. However, as we know, outliers do happen from time to time. Now, keep in mind that these assumptions are just a first gauge of Nvidia's valuation and don't incorporate qualitative information from more advanced analyses such as Analysis 2.0. Before making any investment decision, I would need to stress these assumptions. But for now, I hope this gives you a good idea of where Nvidia stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 24.5% for bull case, 14% for bear case, 1% for extreme bull case, and 0.5% for extreme bear case. Based on the probabilities and assumptions considered, the final price target for the stock to achieve a 12% yearly return is $355.53. This indicates an overvaluation of 18.8% compared to the current trading price. Surprisingly, this level of overvaluation is lower than what I was expecting, considering the insane growth Nvidia's stock has experienced recently. The graph clearly shows that Nvidia is currently trading in overvaluation territory. However, it's intriguing to note that there was a period between June 2022 and January 2023 when the stock was available in undervaluation territory. Opportunities like these come and go, and it's essential to stay aware and seize them when they arise. Who knows, there might be a chance for Nvidia stock to experience a crash and return to fair value territory in the future. I would certainly be glad, as this is an awesome business in an amazing industry. Remember, my friends, the stock market is dynamic and ever-changing. Valuations can fluctuate over time based on various factors, including market sentiment, company performance, and industry trends. Stay vigilant, follow your favorite dude, and he will keep an eye out for potential opportunities. But our work isn't done yet. We still one last step in this analysis 1.0, multiple valuation. And in this method, Nvidia is considered an extremely overvalued business. The valuation multiples indicate that Nvidia should only be valued at $164.46, which is 62.5% below the current price. This may seem harsh and perhaps even impossible, but it's worth noting that Nvidia was trading at these values just 5 months ago. And now it's time to wrap up the first analysis of Nvidia's business by comparing the 3 different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Nvidia is a good business and if had what it takes to move on to Analysis 2.0. Using the 5 dimensions method, we assessed Nvidia's overall performance, resulting in a final rating of 2.92, indicating a promising business. Notably, Nvidia excels in the growth dimension, earning a perfect score. It also demonstrates exceptional strength in the solvency dimension, with a 4.2 rating. However, there are concerns when it comes to Nvidia's profitability and valuation, as highlighted by the 5 dimensions approach. Despite this, Nvidia holds a dominant position in the GPU market and foresees significant growth in the coming years. Particularly, the data center segment is expected to be a driving force behind this expansion. Additionally, Nvidia is exploring opportunities in emerging areas like AI, robotics, and self-driving vehicles. Considering these factors, coupled with their strong financial position and expected cash flow generation, Nvidia seems well positioned to capitalize on the ongoing trends in the semiconductor industry. Nevertheless, we can't overlook the importance of valuation. Thus, our secondary mission today was to evaluate Nvidia's value. Through the DCF valuation, we found that the company is slightly overvalued, albeit not as much as I was anticipating. Conversely, the multiple valuation approach revealed a significant overvaluation. Taking these findings into account, it's time for my final verdict. Nvidia will proceed to the next round, Analysis 2.0. Although there is an apparent overvaluation, I believe it's crucial to delve deeper into the business. I want to understand whether there are aspects that investors see which I may have missed, or if it's just hype. As such, Analysis 2.0 provides the best opportunity to thoroughly examine the company's business. From this first analysis, we have some questions that need to be addressed in the second analysis. What factors contribute to the disparity between net income and free cash flow? As investors, we seek profits backed by reliable cash flows. Why did Nvidia's margins experience a hit in the past year? Was it due to changes in the product mix, price reductions, or increased input costs? How strong is Nvidia's moat to protect its business against other competitors? What justifies the high valuation given to Nvidia by investors? And that's it, dudes. If you can't wait for my second analysis of Nvidia stock, please consider subscribe to the channel, turn the bell on, hit the like button, and share with your friends and family. It would help the channel grow and reach more people that need to see this type of analysis. Together we can make a difference. Peace, dudes. You rock.